Coreweave, from crypto mining to AI infrastructure kingmaker. The morning of March 28, 2025, marked a watershed moment in the AI infrastructure wars. Coreweave, a company that just 5 years earlier was mining Ethereum in a New Jersey warehouse, rang the opening bell at the New York Stock Exchange. At $40 per share, the IPO raised $1.5 billion and valued the company at $23 billion, making it the largest tech IPO since Rivian's 2021 debut. Yet within minutes of trading, the stock flatlined, hovering stubbornly at its offering price as Wall Street grappled with a fundamental question. Was this the next AWS, or had the market just crowned the WeWork of AI infrastructure? The stakes couldn't be higher. Coreweave powers the computational backbone of OpenAI's ChatGPT, handles Microsoft's Overflow AI workloads, and controls over 250,000 Nvidia GPUs, more than many sovereign nations. In 2024 alone, the company generated $1.9 billion in revenue, a 730% increase from the previous year. But it also burned through $6 billion in cash and carried $13 billion in debt, numbers that made even the most bullish investors pause. How did three commodities traders with no background in technology build what Microsoft CEO Satya Nadella privately calls mission-critical infrastructure for the AI revolution? The answer involves perfect timing, a contrarian bet on specialized cloud computing, and a willingness to leverage GPUs as collateral in ways that made traditional financiers' heads spin. It's a story that illuminates not just one company's trajectory, but the entire economic architecture underlying the AI boom. This is the story of Coreweave, a company that transformed from crypto miners to kingmakers in the AI gold rush, and whose IPO forces us to confront whether we're witnessing the birth of a new computing paradigm or the peak of a speculative bubble. The journey from Atlantic Crypto to a $23 billion public company reveals lessons about timing markets, the power of pivots, and what happens when you own the shovels in history's greatest gold rush.
Picture three Wall Street commodities traders in 2017 staring at their Bloomberg terminals as Bitcoin crossed $10,000 for the first time. Michael Intrater, Brian Venturo, and Brannon McBee weren't crypto evangelists or tech visionaries. They were numbers guys who understood arbitrage, supply chains, and, most importantly, how to spot inefficiencies in markets. What they saw in cryptocurrency wasn't a new monetary system. It was a commodities play with a technological twist. We approached it like we would approach natural gas or copper, Intrator would later tell investors. The trio founded Atlantic Crypto in a nondescript warehouse in Roseland, New Jersey, not to revolutionize finance, but to mine Ethereum profitably. Their edge? While Bitcoin miners were racing to build custom ASIC chips, Ethereum's algorithm favored GPUs, the same graphics cards gamers used for Fortnite and Call of Duty. The operation started modestly, a few hundred Nvidia GPUs humming away in racks, generating ether while the founders optimized cooling systems and negotiated bulk electricity rates. By mid-2018, Atlantic Crypto had scaled to thousands of GPUs across multiple facilities. They weren't the largest mining operation, but they were among the most efficient, applying commodities trading discipline to cryptocurrency mining. Every GPU purchase was hedged, every kilowatt hour of electricity was optimized, and every ether mined was immediately converted to dollars. The relationship with Nvidia began purely transactionally. Atlantic Crypto would buy GPUs in bulk, often purchasing entire production runs of specific models. But something interesting happened during these negotiations. Nvidia's enterprise team started paying attention. Here was a customer buying GPUs at scale, operating them 24/7 and generating detailed performance data across thousands of units. The miners had inadvertently become one of Nvidia's largest stress testers. Then came the crypto winter of 2019. Ethereum's price crashed from $400 to under $100. Mining operations shuttered across the globe. Atlantic Crypto's competitors liquidated their GPU inventories at fire sale prices, flooding the secondary market. The smart money was getting out. But Intrator, Venturo, and McBee saw something different. They had built relationships, infrastructure, and operational expertise. More importantly, they had noticed something peculiar. Visual effects studios and AI researchers kept calling, asking if they could rent GPU time for rendering and model training. The calls increased even as crypto prices plummeted. In December 2019, the founders made a decision that would define their future. They changed the company name from Atlantic Crypto to Coreweave. It wasn't just a rebrand. It was a recognition that their real asset wasn't cryptocurrency mining capability. It was the GPU infrastructure itself, and the expertise to operate it at scale. While the rest of the crypto mining world was liquidating, Coreweave was preparing to pivot into something entirely different, becoming the specialized cloud provider for the coming AI revolution.
The year 2020 opened with Coreweave operating what was essentially a massive GPU farm looking for a purpose. The pivot from crypto mining to cloud services wasn't elegant. It was desperate experimentation that gradually revealed a massive market opportunity. The first customers weren't AI companies. They were visual effects studios working on projects like The Walking Dead and Rick and Morty, desperate for rendering power during pandemic production crunches. We literally had VFX artists calling us at 2 a.m. asking if we could spin up another 1,000 GPUs by morning, recalls one early employee. Coreweave's scrappy team would manually provision clusters, often writing custom scripts on the fly to meet bizarre requirements. Where AWS would take weeks to approve and provision specialized instances, Coreweave could deliver in hours. They weren't competing on polish. They were competing on saying yes when everyone else said it's complicated. The company's infrastructure philosophy emerged from these chaotic early days. Build for GPU-native workloads first, everything else second. While hyperscalers treated GPUs as expensive add-ons to CPU-centric architectures, Coreweave redesigned everything, networking, storage, cooling, around the assumption that GPUs were the main event. They used InfiniBand interconnects when others used Ethernet, implemented bare metal access when others virtualized, and located data centers based on power availability rather than network proximity. By 2021, the customer base had evolved beyond VFX to include pharmaceutical companies running molecular simulations, hedge funds backtesting trading strategies, and increasingly, AI researchers training computer vision models. Revenue grew from essentially $0 to $16 million, tiny by cloud standards, but with 90% gross margins that made traditional data center operators envious. Then came the bet that would define Coreweave's trajectory. In early 2022, Nvidia announced the H100 GPU, promising 9x performance improvements for large language model training. The chips wouldn't ship until late 2022, cost $30,000 each, and required entirely new cooling and power infrastructure. Most companies placed modest test orders. Coreweave committed $100 million for thousands of units, essentially betting the company on unproven hardware for a market that barely existed. The timing seemed insane. Interest rates were rising, tech valuations were crashing, and crypto, Coreweave's original market, had entered another brutal winter. The company operated just 3 data centers, had fewer than 50 employees, and was burning cash to build out infrastructure. Investment committee meetings at potential funding sources ended with variations of interesting technology, unclear market. October 2022 brought validation in an unexpected form. Coreweave launched an accelerator program offering free GPU credits to AI startups. Within weeks, they received over 1,000 applications. The demand signal was unmistakable. Small AI companies were desperate for affordable GPU access, but couldn't get allocations from AWS or Azure. Coreweave had found its niche, the long tail of AI innovation that hyperscalers ignored. By November 2022, the company had grown to 10 data centers and secured a $200 million funding round led by Magnetar Capital. The pitch was simple. AI compute demand was about to explode, the hyperscalers couldn't serve everyone, and Coreweave was the only specialized alternative with scale. Investors were skeptical but intrigued. Then, on November 30th, 2022, OpenAI released ChatGPT to the public. Within 5 days, it had 1 million users. The AI gold rush had begun, and Coreweave owned many of the shovels.
The evening of November 30th, 2022, felt like any other in Coreweave's Roseland headquarters. Engineers were monitoring cluster performance, sales teams were wrapping up calls with VFX studios, and the leadership team was reviewing their H100 purchase orders. Then, ChatGPT went live. Within 72 hours, the AI world had fundamentally shifted, and CoreWeave found itself at the epicenter of a computational earthquake that would reshape the entire technology industry. The immediate impact was visceral. CoreWeave's website traffic spiked 400% in December. Inbound sales inquiries jumped from dozens per week to hundreds per day. Companies that had never heard of CoreWeave suddenly needed GPU clusters. Not next quarter, not next month, but immediately. The scrappy cloud provider that had been begging for attention was now fielding calls from Fortune 500 CTOs at midnight. But the most consequential call came from Redmond. Microsoft had agreed to spend potentially billions of dollars over multiple years on cloud computing infrastructure from CoreWeave, signing the deal earlier in 2023 to ensure that OpenAI would have adequate computing power. The backstory was remarkable. Satya Nadella's team had watched ChatGPT's explosive growth and realized Azure couldn't scale fast enough to meet OpenAI's demands. They needed overflow capacity immediately. The Microsoft partnership represented validation and risk in equal measure. CoreWeave's revenue had gone up by many multiples from 2022 to 2023, with the software giant becoming their anchor customer. But the deal's structure was unconventional. Microsoft wasn't just renting capacity, they were essentially subsidizing CoreWeave's expansion to ensure OpenAI had the infrastructure to scale ChatGPT globally. April 2023 brought another pivotal moment. Nvidia invested $100 million in CoreWeave, which in April was valued at $2 billion. This wasn't just financial backing, it was strategic positioning. Nvidia recognized that CoreWeave had become a critical distribution channel, a company that could absorb massive GPU allocations and immediately monetize them through AI workloads. The circular nature of the relationship raised eyebrows. Nvidia was investing in a company whose primary asset was Nvidia's own hardware. The summer of 2023 saw CoreWeave execute one of the most creative financing moves in tech history. In August 2023, CoreWeave secured a $2.3 billion debt financing facility, led by Magnetar Capital and Blackstone, by using Nvidia's H100 GPUs as collateral. The deal marked the first time that H100-based hardware had been used as collateral. Traditional lenders had never seen anything like it, using depreciating computer hardware as collateral for billions in debt. But CoreWeave's pitch was compelling. These weren't just servers. They were revenue-generating assets with multi-year contracts already in place. The operational challenges of this period were staggering. CoreWeave's data center technicians installed 6,000 miles of fiber optic cabling in 2023, enough to stretch from New York to London and back. They were essentially building the equivalent of a major telecommunications network, but doing it in months rather than years. Engineers worked in shifts around the clock, racing to bring new capacity online before demand outstripped supply. CoreWeave's website claimed the company could deliver computing power that was 80% less expensive than legacy cloud providers. This wasn't just marketing. It reflected fundamental architectural differences. By specializing in GPU workloads, eliminating unnecessary abstraction layers, and operating at higher utilization rates, CoreWeave could undercut AWS and Azure while maintaining healthy margins. The relationship dynamics between Microsoft, OpenAI, and CoreWeave created a fascinating triangular tension. Microsoft needed CoreWeave to support OpenAI, but CoreWeave's success potentially undermined Azure's AI ambitions. OpenAI needed both Microsoft's capital and CoreWeave's infrastructure, but wanted to maintain independence. CoreWeave needed both as customers, but couldn't afford to be seen as merely an overflow valve for the hyperscalers. By the end of 2023, CoreWeave had transformed from a speculative pivot to a critical piece of AI infrastructure. The company that had started the year with 3 data centers and $16 million in revenue was ending it with over a dozen facilities and revenue approaching $300 million. The ChatGPT explosion hadn't just validated their strategy, it had accelerated their timeline by years, compressing what should have been a decade of growth into 12 extraordinary months.
December 2023 marked the beginning of CoreWeave's transformation from startup to unicorn to decacorn at a pace that defied conventional venture capital physics. The $642 million secondary investment that month wasn't just about capital. It was existing investors and employees cashing out portions of their stakes as valuations soared beyond anyone's wildest projections. The founders, who had risked everything on GPUs when crypto crashed, were now paper billionaires watching their bet compound monthly. The real shock came in May 2024. The company raised $1.1 billion in funding led by Coreweave Management in May 2024, reportedly valuing the company at $19 billion. Just 18 months earlier, the entire company had been worth less than the cash it was now raising. Philippe Lafonce Coatu, known for backing software companies, was making one of its largest infrastructure bets ever, a signal that smart money saw AI compute as the new software. But the May 2024 financing was merely the appetizer. That same month, Coreweave secured a $7.5 billion debt facility, one of the largest private debt financings in history. The lenders weren't traditional banks, but alternative asset managers who understood that GPUs generating $2 million annually could justify $1 million in debt. The facility's structure was revolutionary. Drawdowns tied to customer contracts, repayment schedules aligned with GPU depreciation curves, and covenants based on compute utilization rather than traditional financial metrics. The revenue explosion told the real story. From $16 million in 2022 to $229 million in 2023 to $1.9 billion in 2024. A 730% year-over-year growth rate that made even high-flying SaaS companies look pedestrian. Microsoft accounted for over 60% of Coreweave's revenue in 2024, representing approximately $1.19 billion. This customer concentration would typically terrify investors, but in Coreweave's case, it provided validation. If Microsoft was willing to spend over $1 billion on overflow capacity, the demand was real. The operational scaling was even more dramatic than the financial metrics. By the end of 2024, Coreweave operated 32 data centers with over 250,000 Nvidia GPUs, more computational power than most European countries possessed. Each new facility required negotiations with power companies, cooling system installations, and network interconnections that would typically take years. Coreweave was doing it in weeks. The human story behind this scaling was equally remarkable. The company grew from 50 employees in 2022 to 550 by 2024, hiring everyone from data center technicians to CUDA optimization specialists. The culture remained surprisingly scrappy. Engineers still answered customer calls directly, deals were still closed with handshake agreements before paperwork caught up, and the founders still reviewed major infrastructure decisions personally. October 2024 brought another valuation milestone. According to a Bloomberg News report in October 2024, Cisco was set to invest in Coreweave as well, reportedly valuing the company at $23 billion. The networking giant's investment wasn't just financial. It was strategic recognition that AI workloads required fundamental networking innovations that traditional data center architectures couldn't provide. The secondary market activity in late 2024 revealed something important. Insiders were selling. The three founders collectively sold nearly $500 million worth of shares in secondary transactions throughout 2024. Was this prudent diversification or lack of confidence in their own company's trajectory? The message to public market investors was mixed. The founders were keeping majority stakes but taking substantial chips off the table. Meanwhile, competition was intensifying. AWS launched specialized AI instances. Google Cloud announced massive H100 deployments, and new entrants like Lambda Labs and Crusoe Cloud were raising billions. The land grab for GPU capacity resembled the fiber optic boom of the late 1990s. Everyone knew demand would be massive, but nobody knew if supply would eventually overwhelm pricing power. The infrastructure arms race had another dimension: power. Each H100 GPU consumed 700 watts. A single Coreweave data center could draw as much electricity as a small city. The company was increasingly making location decisions based not on network latency but on power availability. Old aluminum smelting sites and decommissioned nuclear plants became prime real estate. The constraint wasn't chips or capital, it was electrons. By December 2024, Coreweave had achieved something remarkable. It had become systemically important to AI development. If Coreweave's clusters went offline, ChatGPT would slow, Midjourney would queue, and thousands of AI startups would halt training runs. The company that didn't exist 5 years earlier was now critical infrastructure for the AI revolution. The question was whether public markets would value that criticality or focus on the massive cash burn required to maintain it.
The March 2025 IPO roadshow presentations had all the polish of a mature tech company. But beneath the surface, Coreweave's leadership knew they faced skepticism. The S-1 filing revealed numbers that made even seasoned growth investors queasy. $863 million in net losses for 2024, negative $6 billion in cash flow, and projected cash burn of $15 billion for 2025. The founders had already extracted nearly $500 million in secondary sales, a detail that dominated whispered conversations at investor meetings. The pricing negotiations turned brutal. The company had planned to sell shares for between $47 and $55 each, which would have valued Coreweave at $26.5 billion. But institutional investors balked. The macro environment had shifted. Interest rates remained elevated, tech valuations had compressed, and the DeepSeek announcement in January had raised questions about whether AI really needed expensive American infrastructure. On March 27th, reality hit. Coreweave priced shares at $40 in the company's IPO, raising $1.5 billion. Coreweave's valuation will be closer to $19 billion, a 27% haircut from initial expectations. The offering was down from 49 million shares to 37.5 million, another sign of tepid demand. CEO Mike Intrator put on a brave face, telling CNBC that we definitely had to scale or right-size the transaction for where the buying interest was. The OpenAI deal, announced just weeks before the IPO, should have been a game changer. The contract value for this strategic deal is up to $11.9 billion, with OpenAI becoming an investor in Coreweave through the issuance of $350.0 million of Coreweave stock. This represented validation from the most important AI company in the world. Yet investors focused on a different angle. Microsoft had walked away from a similar-sized commitment, and Microsoft has reiterated its plan to spend $80 billion on AI elsewhere. Trading day arrived on March 28, 2025. The IPO price was $40 per share, but opened for trading at 1:21 p.m. ET at $39 per share. The stock closed flat at $40, a devastating verdict for what was supposed to be the biggest U.S. tech offering since 2021. The secondary market action was even more telling. Shares dropped more than 10% on Monday and fell below the initial public offering price of $40. The bear case dominated post-IPO coverage. Customer concentration remained extreme. Microsoft accounted for over 60% of Coreweave's revenue in 2024, with OpenAI now representing the second major dependency. The circular economy concerns were inescapable. OpenAI is paying Coreweave with money that is largely Microsoft's to begin with. The debt load of nearly $8 billion seemed unsustainable given the cash burn trajectory. Yet something shifted in early April. Coreweave's stock popped nearly 42% on Tuesday, bouncing back above its initial public offering price, closing at $52.57, bringing the company to a nearly $25 billion market capitalization. The volatility reflected the market's fundamental uncertainty. Was Coreweave essential infrastructure for the AI age, or an over-leveraged bet on a bubble? The July 2025 acquisition of Core Scientific for $9 billion in an all-stock deal added another layer of complexity. Core Scientific agreed in July 2025 to be acquired for $9 billion. Coreweave projected that the acquisition would help avoid $10 billion in future lease obligations. The strategic logic was clear: vertical integration into data center ownership, but using inflated stock as currency while burning cash raised questions about capital discipline. The IPO had succeeded in one crucial aspect. Coreweave was now a public company with access to capital markets. But the flat debut and subsequent volatility sent a message to other AI infrastructure companies waiting in the wings. The market would fund the AI revolution, but not at any price. The days of blind faith and exponential growth were over. Coreweave would need to prove it could generate positive cash flow before the $15 billion in projected 2025 burn-exhausted investor patience.
Understanding Coreweave's business model requires grasping a fundamental tension. this is simultaneously one of the simplest and most complex businesses in technology. At its core, the company buys GPUs from Nvidia and rents them out at a markup, chip arbitrage, as one analyst called it. Coreweave buys GPUs from Nvidia and rents them out at a markup, essentially playing middleman in the AI compute economy. Yet beneath this simplicity lies an infrastructure operation of staggering complexity. The economics start with pricing power. Lambda Labs is generally positioning itself as a better option for smaller companies and developers working on less intensive computational tasks, offering NVIDIA H100 PCIe GPUs at a price of roughly $2.49 per hour compared to Coreweave at $4.25 per hour. Coreweave charges premium prices but justifies them through specialized infrastructure, bare metal access, InfiniBand networking, and GPU-optimized cooling systems that enable higher utilization rates than competitors. The revenue model follows a usage-based cloud services framework with several twists. Coreweave's customers prepay 15 on 25% of their contract value upfront, allowing the company to fund infrastructure without tapping as much outside capital. These prepayments create negative working capital dynamics. Customers essentially finance Coreweave's expansion. Multi-year contracts provide revenue visibility, with 15.1B in remaining performance obligations, RPO, offering a theoretical revenue floor. But the unit economics reveal the challenge. If you have 250,000 GPUs across 32 data centers spread around the globe, as Coreweave does, you have 2.19 billion GPU hours to peddle in a year with 365.225 days, which works out to 8,186 hours per GPU. That is a lot of hours, and if they were perfectly utilized and every hour of the year was sold at a price of $49.24 per hour for an 8-way GPU instance, as the current Coreweave price for an H100 instance is, then that would generate $13.49 billion. The reality is far messier. Sacra estimates that Coreweave hit 1.9 B in revenue in 2024, up 730% YoY from $229 in 2023, suggesting utilization rates around 14% of theoretical capacity. Even accounting for maintenance, cooling cycles, and network overhead, this implies massive underutilization or strategic capacity hoarding for key customers. The capital intensity is breathtaking. Coreweave CFO Nitin Agrawal explained on this week's earnings call. Our capital expenditures are success-based. We enter into compute CapEx programs when we sign multi-year contracted revenue that more than covers the cost of the CapEx within the contract terms. This sounds prudent until you realize it means spending $23 billion in 2025 alone to meet contracted demand. The NVIDIA relationship adds layers of complexity. Its $1.6 billion supercomputer data center for NVIDIA in Plano, Texas, has been described by NVIDIA as the fastest AI supercomputer in the world. NVIDIA is simultaneously Coreweave's largest supplier, a major customer, and an equity investor, creating circular dependencies that would make traditional analysts nervous. The relationship enables preferential GPU allocations, but also locks Coreweave into NVIDIA's roadmap and pricing power. Customer concentration remains the elephant in the room. 77% of 2024 revenue came from its top two clients, with Microsoft alone accounting for 62%. 77% of Coreweave's revenue comes from two of its customers, the latter of which remains unnamed and is only referred to as Customer C in the document. Once you remove these two big contracts, Coreweave only made $440 million in 2024. Strip away Microsoft and the mysterious Customer C, and Coreweave is a $440 million business, losing nearly $1 billion annually. The gross margin story offers hope. At 76%, Coreweave's gross margins exceed traditional cloud providers, reflecting the premium pricing for specialized GPU compute. But operating expenses and capital costs obliterate these gains. In 2024, the company reported a net loss of $863 million, compared to a net loss of $594 million in 2023. Losses actually accelerated despite 8x revenue growth. The debt structure reveals financial engineering at its most creative. Over the past few years, Coreweave has raised a combined $17.2 billion in debt financing and equity, including IPO proceeds, with major contributions from backers like Blackstone, BlackRock, and Magnetar Capital to fuel its expansion. Using GPUs as collateral for billions in debt was unprecedented, treating compute hardware like real estate. But GPUs depreciate rapidly, lose value with each new Nvidia generation, and become worthless if AI demand normalizes. Coreweave's defensibility rests on three pillars: GPU scarcity, operational expertise, and switching costs. As long as Nvidia GPUs remain scarce and Coreweave maintains preferential access, they can command premium prices. Their ability to deploy and operate hundreds of thousands of GPUs efficiently creates barriers competitors struggle to match. And once customers integrate with Coreweave's infrastructure, migrating petabytes of data and rewriting deployment scripts creates substantial friction. Yet the existential question remains, is Coreweave building sustainable infrastructure advantage or simply arbitraging temporary supply-demand imbalances? But as more companies try to secure their own GPUs or build custom chips like OpenAI's rumored Stargate, does this model have long-term staying power? The business model works brilliantly in a world of GPU scarcity and exponential AI demand. Whether it survives GPU commoditization or an AI winter remains the multi-billion-dollar question.
The competitive landscape for GPU cloud computing in 2025 resembles a three-tier war with Coreweave occupying a precarious throne. According to SemiAnalysis's ClusterMax TM rating system, Coreweave tops the rankings, followed by gold-tier providers like Crusoe, Nebius, Oracle, Azure, Together AI, and Lepton AI. The silver-tier providers are AWS, Lambda, Firma, SHA, Sustainable Metal Cloud, and Scaleway. This hierarchy reflects not just GPU availability, but network architecture, operational efficiency, and pricing sophistication. The hyperscaler threat looms largest. Microsoft plans to invest $80 billion into AI this year. Google will spend $75 billion, while OpenAI is working with Oracle and SoftBank to plunk $100 billion into a network of AI supercomputers as part of its Stargate initiative. These numbers dwarf Coreweave's entire market capitalization. The hyperscaler's strategy is clear. Tolerate Coreweave as overflow capacity during the shortage, then squeeze them out once internal infrastructure catches up. Yet Coreweave has carved out a defensible niche through technical superiority. While this was a significant improvement, it is still 50% slower than its competitors such as Oracle, Microsoft, Coreweave, and AWS when comparing Google's networking performance. Coreweave's RDMA over InfiniBand delivers 3200 Gbps bandwidth, while Google Cloud's A3 Mega offering manages only 1600 Gbps, translating to 15-20% worse training performance for large models. The NeoCloud competition presents a different challenge. Lambda Labs, which also offers an array of cloud-hosted GPU instances, in early April secured a special-purpose financing vehicle of up to $500 million after raising $320 million at a $1.5 billion valuation. Lambda Labs specializes in training and deploying large language models, offering powerful multi-GPU instances for intensive machine learning tasks at $249 per hour for H100s versus Coreweave's $425. They're winning on price but losing on scale and enterprise features. Crusoe Energy, backed by $350 million in funding, takes a unique approach by locating data centers near stranded energy sources, flare gas, renewable curtailment, achieving lower power costs. Together AI, which raised $106 million in March 2024, focuses on open-source model deployment with pay-per-token pricing. Each competitor targets a specific weakness in Coreweave's armor: pricing, sustainability, or flexibility. The Nvidia relationship creates both moat and vulnerability. Coreweave was Nvidia's seventh biggest customer in 2023 at 4.5% of total revenue, putting them among Amazon, Meta, Microsoft, Alphabet, and Tesla. Extraordinary company for a startup. This preferential access to GPUs represents Coreweave's primary competitive advantage. Yet cloud providers AWS, Google Cloud, Microsoft Azure, Oracle Cloud, and Coreweave integrating Nvidia GB200 systems shows Nvidia hedging its bets across all players. The market segmentation strategy has emerged as Coreweave's defensive playbook. The GPU cloud market is segmenting in line with its customers' workload scale. with Coreweave for enterprises that can commit to yearly contracts for exclusive access to thousands of GPUs, Lambda Labs for more flexible growth stage companies, and Together AI for startups that want to pay per token. By focusing on the high-end, massive clusters, multi-year contracts, white glove service, Coreweave avoids commodity price competition. Power and real estate create unexpected moats. By the end of 2024, Coreweave plans to have 28 data centers across the U.S. and abroad. Securing 360 megawatts of power capacity and appropriate cooling infrastructure takes years of planning. Even if competitors have capital and GPUs, they can't instantly replicate Coreweave's physical footprint. The $1.6 billion supercomputer data center for Nvidia in Plano, Texas, represents infrastructure that would take competitors 18 to 24 months to replicate. Customer lock-in provides breathing room, but not permanence. Once enterprises deploy workloads on Coreweave's infrastructure, migrating involves massive data transfer costs, rewriting deployment scripts, and retraining teams. Microsoft's 62% revenue concentration seems dangerous until you realize Microsoft has already invested billions in Coreweave-specific integrations. The switching costs are bilateral. Microsoft is as locked into Coreweave as Coreweave is dependent on Microsoft. The technology roadmap reveals Coreweave's real vulnerability. As AI models grow more efficient, requiring less compute for similar performance, the demand curve could flatten. DeepSeek's January 2025 announcement of models achieving GPT-4 performance with 95% less compute sent shockwaves through the industry. If AI efficiency improvements outpace demand growth, Coreweave's massive infrastructure investments become stranded assets. The competitive dynamics ultimately depend on one question. Is GPU compute becoming commoditized or increasingly specialized? There are 100 of GPU clouds all competing for mostly the same customers, suggesting commoditization. But Coreweave's technical superiority and enterprise relationships suggest specialization still matters. The next 12-18 months will determine whether Coreweave can transition from GPU scarcity beneficiary to sustainable infrastructure provider, or whether they'll be steamrolled by hyperscaler capital and startup innovation.
The Coreweave story offers a masterclass in strategic pivoting, but not the kind taught in business schools. This wasn't a carefully orchestrated transformation guided by McKinsey consultants and board deliberations. It was three commodities traders recognizing their Ethereum mining operation was worth more dead than alive and having the audacity to bet everything on that insight. The art of the pivot, assets over business model. The December 2019 name change from Atlantic Crypto to Coreweave wasn't just rebranding. It was recognition that they'd been in the wrong business all along. The GPUs mining Ethereum were depreciating assets in a declining market. The same GPUs repurposed for cloud computing were appreciating assets in an exploding market. The lesson? Sometimes your means of production is more valuable than what you're producing. Most pivots fail because companies try to preserve too much of their original vision. Coreweave's founders showed no such sentimentality. They didn't try to blend crypto and cloud, didn't hedge with a gradual transition, didn't keep one foot in their original market. They killed Atlantic Crypto completely and rebuilt from scratch. This wasn't iteration, it was reincarnation. Timing markets, the prepared mind, meets opportunity. Coreweave's timing appears miraculous in hindsight. They pivoted to GPU cloud in 2019, invested $100 million in H100 in early 2022, and had infrastructure ready just as ChatGPT exploded in November 2022. Lucky? Perhaps. But luck favors the prepared infrastructure. The key insight: Coreweave didn't try to predict exactly when AI would explode. They positioned themselves for whenever it happened. Building data centers in 2020, 2021 when nobody cared about GPU compute seemed insane. By late 2022, it seemed prescient. The lesson isn't about prediction, it's about positioning for optionality when others are retreating. Capital strategy, financial engineering as competitive advantage. Coreweave's financing innovation, using GPUs as collateral for billions in debt, represents financial engineering at its most creative. Traditional lenders had never seen anything like it. Computer hardware that generated predictable cash flows, appreciated in value during shortages, and could be repossessed and redeployed if necessary. The $2.3 billion debt facility in August 2023 wasn't just capital raising, it was market validation. If Blackstone and Magnetar would lend against GPUs, it meant these weren't just computer parts but productive assets. This reframing allowed Coreweave to leverage hardware in ways competitors couldn't, turning a capital-intensive business model into a capital-efficient growth engine. The prepayment structure, requiring customers to pay 15 to 25% upfront on multi-year contracts, flipped traditional cloud economics. Instead of Coreweave financing customer growth, customers financed Coreweave's expansion. This wasn't just smart financing, it was risk transfer that aligned incentives perfectly. Customer concentration, feature, not bug. Conventional wisdom says customer concentration is death for startups. Coreweave turned it into a moat. By having Microsoft represent 62% of revenue, they weren't just concentrated, they were essential. Microsoft couldn't easily replace Coreweave without massive disruption to OpenAI and Azure AI services. The playbook, embrace concentration when you have leverage. Coreweave didn't try to diversify prematurely. They doubled down on Microsoft, became indispensable, then used that relationship as a calling card for other enterprise customers. Concentration plus criticality equals pricing power. Building in a gold rush, the picks and shovels reality. Everyone cites the picks and shovels analogy for gold rushes, but few understand its implications. Selling shovels isn't glamorous. You're not finding gold, you're enabling others to find it. Your success depends entirely on others' continued belief that gold exists and is worth pursuing. Coreweave's execution shows how to play this dynamic. First, secure supply, GPU allocations from Nvidia. Second, add value beyond simple resale, specialized infrastructure, operational expertise. Third, lock in demand before supply arrives, multi-year contracts signed before GPUs delivered. Fourth, use other people's capital, customer prepayments, asset-backed lending. The founder's dilemma, cashing out versus conviction. The founder's secondary sales, nearly $500 million extracted before the IPO, sent mixed signals. Was this prudent diversification or lack of faith? The playbook insight, founder liquidity can be a feature if managed correctly. By taking chips off the table, the founders removed personal financial pressure, allowing them to make long-term bets without existential risk. But timing matters. Selling before the IPO when employees couldn't created cultural friction. Selling while raising capital at ever higher valuations suggested asymmetric information. The lesson, founder liquidity should follow, not lead, employee and investor liquidity events. Speed, as strategy Coreweave's operational velocity from 3 data centers to 32 in 2 years wasn't just growth, it was strategy. In markets with network effects and scale advantages, speed compounds. Every data center built ahead of competitors locked in power contracts, secured real estate, and created switching costs for customers. The playbook. When you identify a structural advantage, sprint to exploit it before the market recognizes its value. Coreweave's 2022 H100 purchase wasn't cautious experimentation. It was a $100 million bet that speed mattered more than efficiency. They were right. The platform paradox Coreweave faces the classic platform paradox. They need diverse customers to reduce concentration risk, but serving diverse customers reduces their specialized advantage. The playbook response, sequence expansion carefully. First, dominate a niche, AI training. Second, expand to adjacent niches, AI inference. Third, generalize only after achieving scale advantages. Lessons for founders. The Coreweave playbook offers several counterintuitive lessons. 1. Your biggest asset might not be what you think. Regularly reassess what you actually own versus what you do. 2. Timing beats strategy. Position for multiple futures rather than predicting 1-3. Capital innovation can be as important as technical innovation. Find new ways to finance old problems. 4. Concentration works if you have leverage. Better to be critical to one than nice to have for many 5. Speed compounds in winner-take-most markets move fast and break things, including your own business model. 6. Founder liquidity is a tool, not a betrayal, but timing and optics matter immensely. The ultimate lesson from Coreweave's journey. In technology transitions, the companies that win aren't necessarily the ones with the best technology or most capital. They're the ones willing to kill their original business, bet everything on a new vision, and execute with shameless urgency. Coreweave didn't just pivot from crypto to cloud. They recognized that in the AI age, infrastructure is destiny.
Bull case, the AWS of AI. The optimistic view of Coreweave rests on a simple premise. AI represents a computing paradigm shift comparable to the internet, and Coreweave owns critical infrastructure for this transition. Coreweave now sees $5.15 billion to $5.35 billion in revenue for all of 2025, suggesting a 174% growth rate, numbers that justify almost any valuation if sustainable. The demand trajectory appears unstoppable. Revenue growth continues to be capacity constrained, with demand outstripping supply, meaning Coreweave could grow even faster if they had more GPUs. The company's Q2 2025 results showed revenue more than tripled from $395.4 million a year earlier, with major expansions from both OpenAI and unnamed hyperscalers. Every major AI player needs GPU capacity, and Coreweave has it. The backlog provides exceptional visibility, with $30 billion in contracted revenue and $15.1 billion in remaining performance obligations. Coreweave has essentially pre-sold years of capacity. Unlike software companies that must constantly win new deals, Coreweave's revenue is largely locked in through multi-year contracts with creditworthy counterparties. Technical superiority creates sustainable differentiation. Coreweave's infrastructure delivers demonstrably better performance than hyperscalers for AI workloads. Faster networking, higher utilization, lower latency. On a conference call with analysts, Coreweave CEO Mike Intrator pointed to an expansion in business with OpenAI, a major client and investor. And he said Goldman Sachs and Morgan Stanley are becoming customers. When Wall Street banks choose your infrastructure, it validates enterprise readiness. The AI revolution is just beginning. If AI truly transforms every industry, healthcare, finance, manufacturing, entertainment, then current demand represents a fraction of eventual need. Coreweave could grow 10x and still not satisfy market demand for AI compute. In this scenario, customer concentration becomes less concerning as the customer base naturally diversifies. Acquisition optionality provides downside protection. Microsoft, Oracle, or even Nvidia might acquire Coreweave rather than build competing infrastructure. At current valuations, a $50-75 billion acquisition would be feasible for these companies and potentially cheaper than organic expansion. Coreweave's shareholders win either way, through continued growth or a premium buyout. The platform expansion opportunity remains untapped. Today, Coreweave primarily provides raw compute. Tomorrow, they could offer managed AI services, model marketplaces, fine-tuning platforms, and enterprise AI solutions. Each layer of the stack represents additional margin opportunity. The Weights and Biases acquisition signals this strategic direction. Capital markets have proven receptive. Despite the cash burn, Coreweave has successfully raised debt at reasonable rates and equity at increasing valuations. Debt now sits at $11.1 billion, but with contracted revenue supporting it. As long as capital remains available, the business model works. Bear case, the WeWork of GPUs. The pessimistic view sees Coreweave as a massively leveraged bet on a bubble with economics that only work in a world of GPU scarcity and irrational AI exuberance. Coreweave's lowest stock price was $33.52, and its highest was 180 in the past 12 months, volatility that suggests deep market uncertainty about fundamental value. The cash burn is unsustainable. The company registered a $290.5 million net loss, compared with a $323 million loss in second quarter of 2024. Despite massive revenue growth, losses persist. The company plans to spend $20.23 billion in capex for 2025 while generating perhaps $5 billion in revenue. This math doesn't work without perpetual external financing. Customer concentration represents existential risk. 77% of 2024 revenue came from its top two clients, with Microsoft alone accounting for 62%. If Microsoft decides to insource or OpenAI shifts to other providers, Coreweave's revenue could collapse overnight. The recent Microsoft contract modifications and OpenAI's Stargate project suggest this risk is materializing. The debt burden is crushing. With $11.1 billion in debt at likely 8 to 10% interest rates, Coreweave faces nearly $1 billion in annual interest expense before spending a dollar on operations. Rising rates or tightening credit markets could trigger a liquidity crisis. The GPU collateral loses value rapidly as new chips launch. Competition is intensifying from every direction. Hyperscalers are building massive GPU clusters, new entrants are raising billions, and alternative architectures, TPUs, custom chips, threaten Nvidia's monopoly. Coreweave's advantage, preferential GPU access, evaporates as supply increases and alternatives emerge. The AI bubble shows signs of deflating. Coreweave stock has plunged over 50% from its June peak, suggesting market skepticism about AI infrastructure valuations. If enterprises don't generate ROI from AI investments, they'll cut spending, and Coreweave's backlog could evaporate through contract modifications or customer bankruptcies. Lockup expirations create selling pressure. Near-term upside capped by the potential CORZ-related dilution and uncertainty, and the pending lockup expiration. Early investors and employees holding shares at pennies on the dollar have massive incentives to sell, creating sustained downward pressure on the stock. Technological disruption looms. Quantum computing, neuromorphic chips, or breakthrough AI algorithms could render GPU clusters obsolete. Coreweave's entire infrastructure could become stranded assets, like coal plants in the renewable energy transition. The company has no technological moat beyond operational excellence. Financial engineering masks fundamental weakness. The complex arrangements with magnetar, customer prepayments, and GPU-backed debt create the appearance of a viable business model. Strip away the financial engineering, and you have a company losing nearly $1 billion annually with no path to profitability. The verdict: spectacular success or spectacular failure. Coreweave has a consensus rating of hold which is based on 6 buy ratings, 16 hold ratings, and 2 sell ratings. The 15 analysts that cover Coreweave stock have a consensus rating of hold and an average price target of $104, which forecasts a 20.48% increase in the stock price over the next year. The market's ambivalence reflects the binary nature of Coreweave's future. The bull case requires continued AI investment, sustained GPU scarcity, successful execution of massive infrastructure build-out, and eventual transition to profitability. Possible, but each assumption carries risk. The bear case sees unsustainable economics, crushing debt burdens, customer concentration, and technological obsolescence combining to create a spectacular collapse. Also possible with precedents in other infrastructure bubbles. The truth likely lies somewhere between. Coreweave has built real infrastructure serving real demand, but at valuations and leverage levels that leave no room for error. This is a company optimized for one scenario: continued exponential growth in AI compute demand. Any deviation from that trajectory could prove catastrophic. For investors, Coreweave represents a pure play on AI infrastructure with corresponding risks. It's neither the next AWS nor the next WeWork. It's something entirely new. A hypergrowth infrastructure company in the age of artificial intelligence, where normal rules of valuation and prudence have been suspended in favor of land-grab dynamics. The next 12-18 months will determine whether that suspension of disbelief was justified or merely another chapter in the long history of technology bubbles.
Standing at the intersection of Coreweave's journey and the AI revolution's trajectory, we confront a question that transcends one company's fate. What does it mean when the picks and shovels of a gold rush cost billions of dollars and burn cash at rates that would bankrupt nations? Coreweave isn't just a business. It's a referendum on the AI era's economic model. The company's existence challenges fundamental assumptions about technology infrastructure. In previous computing paradigms, mainframes, PCs, internet, mobile, cloud, infrastructure investments eventually generated positive returns through efficiency gains and scale economies. Coreweave inverts this logic. The more they grow, the more cash they burn. The more successful their customers become, the more capital Coreweave needs. It's infrastructure as a service, but also infrastructure as an endless capital sink. Is this the new AWS or the next WeWork? The comparison itself reveals our poverty of frameworks for understanding Coreweave. AWS built profitable infrastructure serving diverse workloads with increasing margins over time. WeWork arbitraged real estate with unsustainable unit economics. Coreweave does neither and both. It's profitable at the gross level, but hemorrhages cash at scale, serves a narrow but exploding market, and exists in a state of permanent capital dependency. Perhaps Coreweave represents something entirely new, infrastructure for a post-scarcity computing world where the constraints aren't processing power but energy, cooling, and capital. In this view, Coreweave isn't a technology company but a utility. Like power companies that built massive generation capacity during electrification, accepting decades of losses for eventual monopolistic returns. The strategic value to Microsoft illuminates another dimension. Microsoft's relationship with Coreweave as customer, enabler, and potential acquirer suggests that in the AI era, infrastructure isn't just strategic, but existential. Companies that can't secure compute can't compete. Coreweave's existence allows Microsoft to pursue AI ambitions without the capital expenditure hitting their balance sheet, financial engineering as competitive advantage. What happens when or if AI demand normalizes? This question haunts every Coreweave analysis, but it assumes AI is a bubble rather than a platform shift. If AI is like the internet, a fundamental layer that transforms every industry, then current demand is embryonic. If it's like blockchain, transformative in narrow applications but overhyped generally, then Coreweave faces existential crisis. The infrastructure layer thesis posits that regardless of which AI applications succeed, they all need compute. Coreweave wins whether OpenAI, Anthropic, or unknown startups dominate as long as someone needs GPUs. It's the selling water in the desert strategy, except the desert might be Earth's permanent climate. Yet the bear case has historical precedent. During the telecom boom, companies like Global Crossing and WorldCom built massive fiber networks anticipating infinite bandwidth demand. They were directionally correct. Bandwidth demand exploded, but temporarily wrong. They went bankrupt before demand materialized. Coreweave could suffer the same fate. Right about AI's importance, wrong about the timeline to profitability. The market's schizophrenic valuation from $40 IPO price to $187 on peak to current $92 reflects this uncertainty. Coreweave's market cap is $48.84, making it more valuable than most S&P 500 companies despite never generating profit. This isn't irrational exuberance or skepticism. It's radical uncertainty about what kind of company Coreweave actually is. The final verdict on Coreweave depends on your view of AI's trajectory. If you believe we're building artificial general intelligence that will transform civilization, then Coreweave's infrastructure is priceless. If you believe we're automating narrow tasks with diminishing returns, then it's drastically overvalued. There's surprisingly little middle ground. What Coreweave means for the AI era is this. We've entered uncharted territory where traditional metrics of business success, profitability, cash flow, return on capital, have been suspended in favor of strategic positioning for an uncertain future. Coreweave embodies both the promise and peril of this suspension. It's either building the foundation for the next economic epoch or the most spectacular infrastructure bubble in history. The company's founders, three commodities traders who stumbled into owning critical AI infrastructure, represent the randomness and opportunity of technological transitions. They didn't set out to power ChatGPT or enable AI research. They were mining Ethereum. The gap between intention and outcome, between Atlantic Crypto and Coreweave, captures the chaos and possibility of the current moment. In 10 years, Coreweave will be either the canonical case study in prescient pivoting or a cautionary tale about infrastructure bubbles. More likely, it will be both. A company that correctly identified a massive opportunity, but whose execution and timing aligned imperfectly with market realities. The infrastructure they're building will persist regardless, powering whatever comes after the current AI boom, even if Coreweave itself doesn't survive to see it. The ultimate irony, Coreweave's success or failure might matter less than what it represents. The willingness to bet everything on a technological transition, to burn billions in pursuit of positioning, to suspend disbelief long enough to build something that shouldn't exist but does. In the AI era, that might be exactly the infrastructure we need.
August 12th, 2025. Q2 earnings. Mistriggers volatility. Coreweave shares slid 9% in extended trading on Tuesday, even as the provider of artificial intelligence infrastructure issued results and guidance that beat expectations. Revenue. $1.21 billion versus $1.8 billion expected. Revenue more than tripled from $395.4 million a year earlier. Despite the revenue beat, the earnings per share, EPS, came in at 0.6, falling short of the forecasted 0.2. EPS missed expectations, reported at 0.6 against a forecast of 0.2. Lockup expiration creates selling pressure. The expiration of CRWV's IPO lockup is approaching in late September, following which insiders and early investors are allowed to sell the stock. The anticipation of this event has created additional volatility, with shares trading between $92 to $148 in recent weeks. Revenue guidance raised for full year 2025. Coreweave now sees $5.15 billion to $5.35 billion in revenue for all of 2025, suggesting a 174% growth rate. The new range is up from the $4.9 billion to $5.1 billion forecast that management gave in May. Analysts surveyed by AIVIII were looking for $1.25 billion in Q3. Revenue growth continues to be capacity constrained, with demand outstripping supply. Nitin Agrawal, the company's finance chief, said on a conference call with analysts, debt concerns. Mount debt now sits at $11.1 billion. In Q2, the company's total debt reached more than $11 billion, and analysts believe it could add another $10 billion by year-end. In fact, Coreweave paid more than 13 times its operating income just to cover the interest on its debt. Major customer expansions. On a conference call with analysts, Coreweave CEO Mike Intrator pointed to an expansion in business with OpenAI, a major client and investor. And he said Goldman Sachs and Morgan Stanley are becoming customers. One of those contracts was signed in Q2 and is reflected in the Q2 revenue backlog number. The other one was signed in Q3 and will be reflected in our Q3 revenue backlog number. Backlog growth decelerates. The $30.1 billion in backlog sure makes it seem so, at least for the foreseeable future. While the $30.1 billion is a significant increase from last quarter's $25.9 billion, the company had already announced a $4 billion deal with OpenAI in its last earnings that accounted for the bulk of the quarter-over-quarter jump. Coreweave only booked $1.4 billion in new contracts this quarter, not as much as might have been expected. Analyst sentiment remains mixed overall. Wall Street is sidelined on Coreweave stock, with a hold consensus rating based on 13 holds, 6 buys, and 2 sell recommendations. The average CRWV stock price target of $107.59 indicates about 17% downside risk. Key concerns include customer concentration, debt levels, and margin pressure from depreciation. Infrastructure expansion continues. A Coreweave data center project in New Jersey with up to 250 megawatts of capacity is set to be delivered in 2026, the company said in the statement. Intrator said later this year, Coreweave aims to start letting people rent out GPUs on a spot basis, potentially opening new revenue streams.
Official company resources. Coreweave Investor Relations. Investors.coreweave.com. Coreweave S1 filing. March 2025. SEC Edgar Database. Q2 2025. Earnings presentation. Investors.coreweave.com. Overview. Default. ASPX Financial Analysis and Research. Analyst coverage. JP Morgan, Goldman Sachs, Morgan Stanley, Wells Fargo, MoffettNathanson. Real-time stock data. CRWV. Finance.yahoo.com. Quote, CRWV. Consensus estimates. TipRanks.com stocks. CRWV Industry Research. Semi-analysis GPU Cloud Cluster Max TM. Rating system. Semianalysis.com. Sacra Research on GPU clouds. Sacra.com Research, GPU clouds growing. Contrary Research Coreweave report. Research.contrary.com for company to Coreweave partnership documentation. Microsoft Coreweave relationship, CNBC reporting, June 2023. OpenAI 11.9b. Contract announcement, Coreweave press release, March 2025. Nvidia investment. Details, SEC filings, and company announcements. Books and recommended reading, The New Thing by Michael Lewis on infrastructure. Boom, Bust Cycles. Chip War by Chris Miller. Semiconductor Industry Dynamics. The Phoenix Project. IT Infrastructure and DevOps Transformation. 0 to 1 by Peter Thiel. On building monopolies in technology, podcast interviews and media. Coreweave CEO appearances on CNBC Squawk Box. Acquired .fem episodes on infrastructure companies. The Information's reporting on AI infrastructure. Stratechery analysis of cloud computing economics. Technical architecture resources. Coreweave cloud platform documentation. Nvidia H100 GB200 technical specifications. InfiniBand networking white papers. GPU cluster optimization guides, market research reports. Gartner Magic Quadrant for Cloud Infrastructure, IDC AI Infrastructure. Market analysis. Bloomberg Intelligence GPU Cloud Reports. McKinsey Global Institute AI Adoption Studies. Regulatory filings. All SEC filings. SEC.gov/Edgar. Search ticker. CRWV. Quarterly earnings transcripts. Insider trading reports. Form 4. Institutional ownership changes. 13 FE filings.